Banks are everywhere. They are so deeply woven into our daily lives that most of us don't even notice them anymore. Your salary passes through a bank. Your rent, your mortgage, your credit card, your savings. All of it flows through the same system. We trust banks the same way we trust electricity or running water. We don't really think about how it works. We just assume it has to work this way. Even the Federal Reserve, the most powerful financial institution on the planet, is, at its core, a bank. A very special bank, yes, but still a bank. It creates money, controls interest rates, and quietly shapes the entire economy from behind the scenes. But here's the uncomfortable truth most people never hear out loud. The modern banking system does not need you to become financially free. It only needs you to keep participating. And once you understand how banks actually make money, you begin to see why debt, stress, and confusion are not side effects of the system. They are features. Today we're going to talk about how banks make money when you lose, why this system feels so hard to escape, and why understanding it changes the way you look at money forever. Stay until the end, because this isn't about hating banks. It's about finally seeing the rules of the game you've been playing your whole life. Let's start with something that feels safe and familiar. Saving money. From a young age, we're told that putting money in a bank is responsible. You work hard, you save a little, and the bank rewards you with interest. At least, that's how it sounds in theory. But when you actually look at the numbers, the illusion starts to fall apart. Most major banks today pay less than 1% on savings. Some don't even reach 0.5%. Meanwhile, inflation quietly eats away 2, 3, sometimes even 5% of your purchasing power every single year. So while the number in your account barely changes, the real value of your money is shrinking. What this means is simple but uncomfortable. Keeping money in a bank doesn't grow wealth. It slowly erodes it. A bank is not designed to make you richer. It's designed to store money temporarily and move it through the system. And that brings us to the part most people never stop to think about. What does the bank actually do with your money once you deposit it? When you put $1,000 into a bank, that money does not sit there waiting for you. The bank doesn't lock it in a vault and guard it like treasure. In fact, keeping it idle would make no sense at all. The bank wouldn't even be able to pay you that tiny interest rate if it did. Instead, the bank lends your money out. But not in the way most people imagine. Here's where things get interesting. Banks operate on something called fractional reserve banking. In simple terms, they are only required to keep a small percentage of deposits on hand, often around 10%. The rest can be used to create loans. So when you deposit $1,000, the bank keeps maybe $100 and uses the remaining $900 as the basis to issue new loans. And here's the key part. That $900 is not taken from your account. You still see your full $1,000 when you check your balance. Now someone else receives a loan for $900. They see that money in their account too. Suddenly, there is $1,900 in the system, even though only $1,000 was originally deposited. The extra money was created digitally, with nothing more than accounting entries. This isn't a conspiracy. This is how the system is officially designed to work. And the bank now charges interest on money that didn't exist before. Once you see this, a lot of things start to make sense. Banks don't care much about your savings account because that's not where the profit is. The real money is made on the other side of the equation. Think about the difference. They pay you 0.5%, but they charge you 6% on a car loan, 7 or 8% on a mortgage, 20% or more on a credit card. That gap is the business. Banks don't want you to pay off debt quickly. They want you to carry it calmly, quietly, and for as long as possible. That's why minimum payments exist. That's why credit card balances feel manageable until they're not. As long as you keep paying, the system is working exactly as intended. Then there are fees, overdraft fees, late payment fees, account maintenance fees, foreign transaction fees, penalties for falling just slightly out of line. Notice something important here. These fees don't target wealthy people. They target mistakes. And who is more likely to make mistakes with money? People living close to the edge. The less financial margin you have, the more expensive life becomes. Stress becomes a revenue stream. And slowly, without anyone ever saying it out loud, money stops being a tool and starts becoming a source of anxiety. At some point, you stop being seen as a human being in the system. You become a number. Your credit score determines how expensive money is for you. It decides whether you rent or own, whether you get approved or rejected, sometimes even whether you're trusted at all. Here's the cruel irony. The more you need help, the worse the terms become. High risk means high interest. Struggle is punished with cost. And yet, on the other end of the spectrum, the rules quietly reverse. Let's talk about rich people for a moment. Mark Zuckerberg once took out a mortgage on a multi-million-dollar home, despite being worth billions at the time. To most people, that sounds insane. Why borrow when you can easily pay cash? Because when interest rates are lower than inflation, borrowing becomes cheap, sometimes even profitable. If inflation is 3% and your loan is 1%, the real value of that debt shrinks over time. The bank gets paid back with weaker dollars. Meanwhile, your own money stays free to be invested elsewhere. This is why the wealthy don't rush to pay off low-interest debt. They understand something most people never learn. Not all debt is bad. Banks love clients like this. They're predictable, low risk, long-term, profitable without drama. And that's why the rich get cheaper money. Banks are not evil. They're rational. Lending to someone with assets is safer than lending to someone living paycheck to paycheck. A billionaire missing a payment is unlikely. An employee losing a job is very possible. So the system evolved to protect itself. And in doing so, it began favoring asset owners over income earners. This is why credit cards are so powerful and so dangerous. Credit card interest isn't 5%. It's often 20% or more. And a shocking number of people can't pay their balances off anytime soon. Debt grows faster than income, and the trap tightens quietly. Credit cards are sold as convenience, but they're priced for human weakness. Used responsibly, they build credit. Used emotionally, they build profit for the bank. Here's the most important realization of all. Banks don't need you to fail financially. They just need you to stay slightly behind. The perfect customer isn't rich. The perfect customer is stable, stressed, and dependent. Someone who works, borrows, pays, and repeats. Once you understand this, the system loses some of its power over you. Not because you've escaped it, but because you finally see it. And seeing the game is always the first step to playing it differently. If you want more videos like this, breaking down money, power, and the systems behind everyday life. Subscribe to the channel. This is where we learn how the world actually works.